So how can you avoid the startup valley of death post-Series A? You do that by looking at monthly metrics, weekly metrics to support those monthly metrics, and really measuring the growth experiments that you have and looking at them on a daily, weekly basis. As I said, it's not just for the sake of satisfying the board, but more importantly, it's a huge determinant of how successful and how quickly a scale-up becomes a global growth business. So on this slide, I laid out 5 of the key buckets in which you would look at metrics for a SaaS company. And the ones that are most important, particularly for companies less than 10 million of ARR, are really the first 4, which are annual recurring revenue, or otherwise known as ARR, gross margin, CAC and CAC Payback, cash burn, and cash runway. Capital efficiency is also important, but it only starts really mattering when you're 5, 10, and beyond in annual recurring revenue. Now, I'll talk about these in tandem, one by one. So annual recurring revenue basically indicates the scale of a business and the likelihood of survival. It also tells you about the maturity of the company overall. So in the 1 to 5, and even arguably so in the 5 to 10 million ARR range, you're still very much as a business in new logo acquisition mode. When you start getting to 5 to 10 and definitely beyond 10, you're then in a phase of maximizing lifetime value. What it also tells you is the overall readiness of a business to scale. So in addition just to looking just at top line ARR, what you would ideally also be tracking, especially when you're at the 5 million ARR stage, is the different buckets of ARR. So new, expansion, downgrade, and churn. This also, and overall the breakdown of it, as well as the shape of it, tells you a lot about the readiness of a business to scale. And the way you would then deep dive into understanding that better is looking at cohorts across different geographies and different types of customers. The gross margin is basically net of the annual recurring revenue less the cost to deliver. And for most SaaS companies, the cost to deliver is predominantly hosting, as well as customer support, especially as you move into the mid and enterprise software segments. And typically gross margin can be anywhere from 65 to 90%. Of course, it's a big range. And the reason for that big range is it's one, a function of business maturity. So what I mean by that is as an enterprise business, you get to scale a lot later. So it could be 10 million or plus in ARR. As a product-led growth company, you get to scale much earlier. And so therefore, that's also reflected in the gross margin. An enterprise company is more likely to be closer to 65% gross margin. A product-led growth company is more likely to be closer to 90% gross margin. This, as a result, is also a reflection of customer segmentation and overall also team and product efficiency. So if your product really has a seamless and frictionless onboarding experience, then you would expect your customer support to be quite minimal, and therefore you would have higher gross margins as a result. The pattern in which you look at gross margin on a month-to-month, quarter-by-quarter basis shows a very strong signal in terms of product market fit. So very tight product market fit is shown through the stability of gross margins. Now, CAC, which stands for cost of customer acquisition, and CAC payback, is essentially net of the gross margin to acquire a customer. And typically acquisition channels are, in today's world, mostly marketing and sales. And so when you look at this, the payback in which you acquire a customer, so the number of months in which you break even on acquiring a new customer, can vary anywhere from 3 to 24 months. Again, that's a really big range because it's really a function of your go-to-market strategy, your motion, ultimately your product delight, and also your efficiency in getting your product shipped out to as many customers as possible. Having strong quarter-over-quarter stability signals tight go-to-market fit. So for an enterprise business, looking at CAC on a monthly basis is not so relevant. You would look at it on a quarterly basis, and you might even look at it on a biannual basis. For a product-led growth company, I would expect patterns around CAC and CAC Payback, where you can start looking at it on a monthly and for sure quarterly basis. The next one is cash burn or cash runway. So this basically is a reflection of how many months you have remaining to grow into your business inflection point. From a finance point of view, typically business inflection points happen at 1 to 2 million ARR, 5 to 10 million, 5 million ARR, 10 million ARR, 20 million ARR, 30, 50, 80, 100, 150 million ARR. These are also where you would, in a normal financial capital markets market, see an increase in the overall valuation and therefore enterprise multiple of a business. So when a buyer looks to purchase a company in an exit scenario, there are clear valuation inflection points that trigger a higher valuation, aside from, of course, how the process is run. Now, typically high growth companies will always have somewhere between 6 to 18 months of cash runway. 6 months of cash runway reduces your funding optionality as a business, because people know that you are reliant on them for external funding and therefore growth. More than 18 months of cash runway signals that you have hiring challenges or scalability challenges. This is the natural nature of a high growth venture-backed business. Now, the last bucket, call it, of metrics is really around overall business and team productivity. This is quite important to look at when you're looking to exit a company or from the perspective of a growth investor. And there's a lot of different ways in how you can calculate capital efficiency, and I've listed a few different ones here. For instance, looking at the net new ARR relative to the net cash burn on a quarterly or annual basis. The other one, which is a very kind of quick and dirty way of looking at businesses, which I like because you can then just go onto LinkedIn and quickly derive the number, is to look at the headcount of the business and apply a rule of thumb of somewhere between $100K to $150K per full-time employee. Now, this rule of thumb only really, takes place when the business is more than 100, 150 people, because at that point you're somewhere between 10 to 15 million ARR. And at that point in time, a software business typically has achieved economies of scale. There's also a quite popular one called Rule of 40, which is essentially looking at the percentage year-on-year or quarter-on-quarter growth and measuring that relative to the percentage burn over revenue. And that's basically to look at how efficient it is to acquire each additional customer on a business level. And the last point, which I touched upon already, is that this is really most relevant for companies that are either looking to exit because buyers do look at efficiency, and or growth investors that are focused on relative value rather than high growth.